A 1960s echo? It's 2025 and the world feels like it's unraveling. Political assassinations, raging populism, and cultural clashes that echo the chaotic 1960s. Are we reliving that turbulent decade? And if so, what does it mean for markets and the economy? Protests in the street, distrust in institutions, anti establishment fury sound familiar. We're not just in a political flashback, we're barreling toward an economic one too. Think 1965 to 1982, the era of the great inflation, stagflation nightmares, and most assets getting absolutely crushed, all but one. So here, for viewers of the channel, since the beginning, this will sound very familiar. I've been talking about this kind of 1960 into 1980 historical analog as being quite likely for where the U.S. is headed. Recent events that are grabbing headlines only confirm that thesis that I've had for a while now. So I decided to do a video on this and walk through some of the important points. So first, we're going to look at cash. And of course, this is not physical cash, but short-term U.S. Treasury bills. And the chart, by the way, starts in 1958, goes through 1982. We can see that short-term interest rates were up and to the right. Generally speaking, interest rates went from about 1.1% in 1958 up to as high as 16% in 1981. So generally up and to the right. Now, again, this might look good for those of you that have been in money market funds, collecting interest. Finally, our money is actually worth something. And so savers are finally being rewarded by, 4.5% interest rates. So a lot of people have been enjoying money market funds. This might look good because remember, this is risk-free, essentially. This is risk-free. You're not taking, say, equity risk, operational risk, no risk. You're just putting it in short-term treasury bills, which are very liquid, a net asset value 1 at the end of every day, very, very liquid, very cash-like, and you get interest relatively risk-free. So this generally would look good to those sorts of people that have been enjoying money market funds. But once you adjust for inflation, it is a different story. So here we're taking that short-term 3-month yield and we're subtracting inflation. Once we do that, the story is a lot different. At the low here, by the way, you were losing 6% per year. And this hit that low here in the mid 1970s, and then again in the early 1980s at the peak there. Here at the low 1971, you would have lost a guaranteed 1.8% per year. So it's hard to take an average of this entire period, but generally speaking, once you adjust for inflation, cash or short-term government bonds were not the best place to be. So here we're looking at the yield curve in its entirety, at least as it was back then. We didn't have the 30-year or the 5-year or some of these other tenors that we have now. So here we're looking at the 3-month, very short term, mirrors the Fed. What is the Fed doing? By the way, we had Arthur Burns, and we'll take a look at inflation in a second. But 3-month yield, 1-year yield, 10-year yield. So the 3-month you can think of as kind of the Fed. What is the Fed doing? The 10-year yield, however, is much more on nominal growth expectations. That is what the 10-year responds to. This is why we have seen the 30-year bond yield go up by about 70 basis points since the Fed started to cut the overnight interest rate by 100 basis points last September. The long end of the yield curve is independent from the Fed. And here we can see, again, that 10-year yield as an approximation for the long end of the yield curve. Down here, we're taking a look at the spread, or the difference between long-term interest rates and short-term interest rates. This can tell you, is the yield curve steepening or is it flattening? It does not tell you if it's a bull flattener or a bear flattener. It does not tell you bull steepening, bear steepening. You have to look at the actual yields themselves to get that picture, but it does tell you, is the yield curve flattening or steepening? And what we saw to start off the 1960s was a flattening of the yield curve. We can see the difference between the 10-year and the 3-month. It ended up actually inverting here in the mid 1960s. But generally speaking, to start off, we had a flattening of the yield curve. Well, This generally coincides or indicates economic uncertainty and lower growth expectations. By the way, we have seen a flattening of the yield curve over about the past 2 weeks here in the US. So I started off the 1960s with a flattening, and then around this period of time into the late 60s, early 70s, we got a sharp rise in government spending, inflation. We also had supply shocks, right? Oil crisis, oil embargoes, that sort of thing, driving commodities higher. We also had, of course, the Nixon shock in 1971, where Nixon removed us from the gold standard. That was very dollar negative. That was very inflationary. We'll take a look at those assets and those charts in a second. But then, inflation started to take hold kind of in the mid 1960s. And we do see that, by the way, bonds were not a good place to be, because remember, the value of the bond is inverse to the yield. So as yields are going up, the value of these bonds was going down. And this is going to be especially pronounced at a longer maturity, like, say, the 10-year. Generally speaking, the 10-year yield was up and to the right throughout this entire 15-year period. There were brief moments where you would get a bid into bonds, but generally speaking, rates were up and to the right. And of course, once inflation started to appear, you started to get a steeper yield curve, a much steeper yield curve, about 300 basis points here at the peak in 1972, 1975, 1976, 77, and of course, the early 80s. So here's what the overall economy was doing. Down here, we can see the unemployment rate and then real GDP and inflation. So remember, post World War II, the economy was booming. We basically helped to rebuild Europe. At the peak here in 1950, we actually had 13% real GDP. This is the inflation adjusted growth rate of the US economy, 13% real growth in the economy at the peak there. However, we also had inflation. So inflation peaked at about 9% here in 1950. But generally speaking, kind of following World War II and that post World War II era, we had falling growth. And this especially became true into the 1960s and 70s, as we can see here. We did have brief moments of time where the economy would accelerate, the business cycle would be booming, and we'd get stronger growth. But in general, growth was pretty weak. And again, that is reflected in a flattening of the yield curve, like we saw here from 1960 into 1966. You can see that the bond market was concerned about growth. Well, growth was basically down from a peak here of about 7.8% down to just 2.5% or so. Now, this sounds good compared to where we are today, but that is a different story. Kind of the falling growth rates over the past 70 years, that is a different story. Now, we had very low inflation. So to start the 1960s, you can see unemployment was falling. This was good. Inflation was relatively tame at just about 1.5%. Each of these dotted lines represents a 2% increment for both real GDP and inflation. Inflation was only about 1.5%. Very, very tame inflation. But then what started to happen in the mid 1960s, when populism started to rise, when government spending started to rise, Vietnam War, Great Society, all of these programs, and of course later on commodity shocks, supply side shocks, you got rising inflation. So growth actually fell here from about 8.5% down to 0%. And during that time period, inflation went from 1.5 all the way up to 6%. So you had falling growth and rising inflation. And of course, eventually this recession, you had rising unemployment as well. This is textbook stagflation. We also got it again here, of course, with the oil disruptions, 1972. In the 1970s, you had stagflation where growth was going negative. The economy was shrinking at 2% rate of change at the low there. The economy shrinking, and what is inflation doing? Is going up as high as 12% during the recession. Now, normally, you don't see inflation during a recession. Normally, you might see disinflation or even deflation, which is where prices are going down. Well, not the case here in the 1970s. The 1970 recession, you had rising inflation. This entire period of time, for 4 or 5 years, inflation was up and to the right. And then again, in the mid 1970s, you also had a real reacceleration. Now, it should be noted, Arthur Burns, the Fed, was very loose with their monetary policy. They were very loose. And this is Arthur Burns's legacy, kind of raging inflation and ultra loose monetary policy that was not restrictive enough. We can see inflation, again, generally speaking, went from 1.5% in 1964 all the way up to 14.5% in 1980. So during that 14-15 year period, inflation was basically up and to the right. This coincided with loose monetary policy. Monetary policy was not restrictive enough. We have the Fed talking about cutting rates with equities at all-time highs, gold at all-time highs, home prices at all-time highs. So, draw whatever parallels you might to Arthur Burns. Of course, Jerome Powell does not want to be Arthur Burns. He has mentioned that many times. He wants to be Volcker. And Paul Volcker came in the early 80s and was able to get inflation under control, but it came at a heavy cost. Jerome Powell has said he doesn't want to be Arthur Burns, but we are talking about cuts with asset prices at all-time highs. And by the way, inflation running already at 3%. Core CPI, PPI, PCE, really all inflation metrics are closer to 3% than they are to 2%. And we are talking about cuts with assets at all-time highs. So here we have the oil price. Of course, this was another story of this period of time. You had supply side shocks. By the way, as I took an average for inflation from 65 to 82. During this period of time from 65 through 82, you had inflation average 7%. So right now, inflation is running about 3%. That would be double the rate that it is today, and almost as high as the peak of inflation during 2022. So, of course, you also had oil price shocks. Now, unfortunately, the dollar index, we only have up until 1967. Since 1967, that is when DXY dollar index data starts. So we don't get to look at the early 1960s, but we can see, again, a similar trend for the dollar, which was a weakening of the dollar. Now, of course, 1971 Nixon shock. Nixon removed us from the gold standard, but oil, at least from the mid 60s, oil basically 10x. So you had oil go from about $3 a barrel up to $31 a barrel. So oil 10x'd. This is difficult to wrap your mind around, but this would be the equivalent of oil going to $600 per barrel. It's about $60 around there right now. That would equate to a $600 per barrel oil price. So the what was going on in the oil market was really, really impactful. Imagine what would happen to the economy if you had oil go to $600 a barrel. But of course, it was not just oil. Here in light blue, we have PPI all commodities. And this is a measure within the PPI index that tracks the price of all commodities. And remember, those are the inputs that go into to goods. So you had all commodities similarly in a raging bull market from the 1960s into the 1980s. PPI all commodities went from 33 to 101. We can see that the annual rate of change for commodities was very strong. So here at the peak, by the way, in 1974, commodities were going up at 22% per year. So again, generally speaking, in the early 1960s, you had tame inflation, but then, of course, the Vietnam War, Great Society, government spending, and then, of course, the oil price shocks and the supply side issues in the 1970s, ultra loose monetary policy, all these sorts of things. You get a weakening in the dollar, you get rising commodities, oil 10x'd, and all commodity index 3x'd from 1965 up through 1982. Now, we also were running large deficits, large fiscal deficits. So here we're looking at that federal fiscal deficit, or the difference between government spending and government revenue. And we can see that, generally speaking here, this was a trend that was getting worse. So the fiscal deficit in nominal terms, you can see in white, dotted yellow line represents zero, an even balanced budget. But as a share of GDP is much more informative. And what we can see is from the 1950s, of course, we ran a very, very large deficit in World War II. But coming out of the World War II era, we had an ever increasing deficit. Now, this was to fund again the Vietnam War, and of course, government spending started to pick up. We can see the government spending as a share of the US economy went from about 19% to about 35%. So just from 1950 through into the early 1980s, you almost had a doubling of the size of the government. Government spending grew 2 times faster almost than the overall economy. And we can see, again, some of this it reflected in the fiscal deficit as a share of GDP. Here in the early 1980s, it reached 5% of GDP, 6% of GDP. Currently, the fiscal deficit is already at 7% of GDP. So if we saw increasing populism, and again, it seems pretty clear that this is not a partisan issue. Populism is on the rise with both parties, just kind of in different flavors. Well, generally, that's not good for bonds, as we saw here. The 10-year yield was up and to the right. And generally speaking, you run larger fiscal deficits, it's more inflationary. And of course, we saw that here with inflation averaging 7% from 1965 through to 1982, averaging 7% annual inflation. A large portion of this is government spending and the fiscal deficit growing wider, as we can see again into from the mid 1950s all the way through into the early 1980s. The fiscal deficit, generally speaking, just worsened. The gap between spending and revenue just widened and widened and widened. Well, of course, equities, which a lot of people are probably thinking about, here are equities. So here we're looking at just in US dollar terms, we're looking at the S&P 500 from 1963 up to 1980. And it doesn't look that great. So we can see that there's a lot of volatility, of course, with S&P 500. And again, equities have many more risks than, say, the cash that we were looking at in the first slide, short-term government bills, basically risk-free. Well, not so with equities. With equities, you are taking a lot more risk, and the goal is to have more upside, more gains, more returns, better returns than you would in short-term U.S. Treasury bills. Well, you're taking more risk and hoping for a greater reward. We can see that equities were really volatile, and generally speaking, from kind of the mid-1960s all the way through to 1980, they were sideways in dollar terms. Now, if that looks bad, it gets even worse. So here's the S&P 500 inflation adjusted. So here we're taking the S&P 500 and dividing it by the CPI index. And what we can see is that inflation, again, eroded your real returns. So yes, in dollar values, if you were able to time, say here in the early 1960s, if you bought here and held the entire way, yeah, you might think you're up 83%, but again, because of how brutal inflation was during this period of time from the 60s into the 80s, your real inflation adjusted return was much worse. So in fact, in inflation adjusted terms, as you can see, you would actually be down. You would have lost money. So in dollar terms, yes, your portfolio back then would have showed a green number. But once you adjust for inflation, it would actually be a red number. Now, if that looks bad, it gets even worse. Here's the S&P 500 divided by gold. And again, gold, we went off the gold standard here in 1971. That was the Nixon shock. That was because we were lying about how much gold we had. And remember, the dollar was tied to gold, backed by gold. So we had to have a certain amount of gold to create a certain number of dollars. Well, we were running ever larger deficits. We had the Vietnam War to fund. Basically, we got squeezed and called out on our bluff. And Nixon was forced to abandon the gold standard in the Nixon shock in 1971. Gold absolutely ripped. So during this period of time, gold was just on an absolute tear from the early 1960s just through 1980. So call it about 20 years. Gold returned 706%. So gold was really the place to be because number one, it offered scarcity in a world of ever increasing deficits. As we can see here, the fiscal deficit in general getting worse and worse and worse, hitting a low of about 6% of GDP, which prior to to recent history, a 6% deficit, that is a very large deficit. Well, gold, in a world of increasing currency units, government spending increasing, deficits widening, and of course, inflation, gold is generally what does well during that environment. It is no exception here. We can see gold went a 700% return from the early 1960s into 1980. And once you adjust for currency debasement by using something like gold, you can see the S&P 500 got just absolutely crushed. I believe it was down about 80%. So yes, the number, if you timed it right in the late 50s or early 60s, in dollar terms, that might look like you're up. But once you adjust for real inflation, even using the government's own CPI index, it is a much different story. But especially once you adjust using gold. And when you adjust using gold for actual currency debasement, monetary base expansion, monetary units, increasing monetary units, once you do that, and gold is relatively a good way to do that over long periods of time, once you adjust your equity returns with actual inflation, it was actually quite brutal. You lost a lot of money. And here's just to drive that point home. This is from 1960 through to 1980. This is the percent return for gold and then for the S&P 500. So generally speaking, if we are entering a period of populism, if we are entering a period of time where inflation is kind of here to stay, we have structural inflation, which will likely be going up and to the right over time. And this is due to many reasons: the fiscal and the debt, of course, deglobalization, all of the various things we've been talking about for many months now. If you have rising inflation, of course, a shrinking labor supply, at least under this administration, you will have higher structural inflation due to all of those inflationary forces. Now, you do have an offset with AI and productivity gains, which are starting to come in quite strong, but we'll have to wait and see if those are consistent, if those productivity gains will persist, because we do have a lot of inflationary headwinds over the next decade or 2 decades or so. And generally speaking, during these periods of time of high economic uncertainty, both domestic and international, of course, remember the Vietnam War, generally speaking, something like gold is, at least what history tells us, that is the place to be. It offers you scarcity, so it protects you against the money supply increasing, and it protects you against inflation, but it also protects you from uncertainty, because gold is a bearer asset. Whoever has the gold in his hand has the gold, right? There is no centralized authority that you have to rely on or anything like that. It is a scarce bearer asset. And during times of economic uncertainty and high inflation, gold just absolutely crushes the S&P 500, which, by the way, in nominal US dollar terms over this time period was up 98%. Of course, once we go back here and adjust for inflation, we can see that it's a much different story, because remember, inflation averaged 7%. So, and especially once you adjust for gold, it is an even more brutal. Like here, if you bought the S&P 500 in 1967, it was trading at 2.7 in gold terms. Well, 2.7 down to 0.3. I believe that's about an 80% return, negative return in real terms. So this is at least what history tells us. Yes, a lot of people are starting to talk about the parallels with the 60s. It's up to you to determine whether you see the parallels, whether you think this is the direction that we are heading in. But it does seem quite likely that the number of parallels is starting to get pretty striking, not only domestically, but kind of from a structural demographic theory as well, with the fourth turning and Peter Turchin's work and that sort of a lens as well. Well, if that's the case, we can expect a bear market for bonds and rising interest rates. We can expect poor growth. By the way, unemployment rose basically for 10, 11, 12 years from the mid 60s all the way through to the early 80s. Unemployment was just kind of up and to the right, as was inflation, again, averaging 7%. This is not good for bonds. It was not good for the dollar. It was good for commodities, but really what it was good for was the gold. So the S&P 500 and equities, really, once you adjust for inflation, once you adjust for monetary expansion using gold as a denominator, once you do that, S&P 500 was really not the place to be. Gold just ran away with the returns during this period of time. So anyways, hopefully that was helpful. Hopefully things start to calm down in America, around the world. Unfortunately, objectively speaking, it doesn't look like that is likely, unfortunately. So hopefully that was helpful, and I'll catch you on the next one.